Hi, I'm Pattu from Freefin Cal. Let's talk about the Franklin fund closure again, and we're going to talk about if this can be prevented from happening again. This is the second part of the talk I gave to the Tamil Nadu Investor Association. Technically, the third part if you count the market outlook. So, this will be the last part, and we're going to talk about if this kind of a problem can be prevented from happening again, and we're going to also talk about safer debt fund alternatives. So, can this be prevented? Now, the quite frankly, it is quite debatable, and like I said last in the last part, basically a repeat of this had happened in 2008. People panicked from everything, every kind of debt funds, and if people want cash, you can't prevent them from pulling out. And mass redemption risk is a problem even for listed bonds, and that was the case in 2008. So there is no real way that this can be prevented from happening again. Every time there is a stock market crash, there is going to be a run on debt mutual funds. The only reason why this has not happened to all mutual funds because of the economic lockdown, and the severity of the crash is not as it was in 2008. In 2008, I think it was a much more bizarre situation where there was a kind of a domino effect, and people did not even know what's going to be the future source of funding and so on. But in this case, in a lockdown, while they're going to worry about the future case of source of funding, at least they're not going to need money as immediately as they needed it in 2008, because most businesses are shut, and in that sense, the sense of urgency, in my opinion, and I could be wrong, in the sense of urgency was significantly lower in 2020 than in 2008. That is the reason why we did not see a widespread redemption. Although yes, there is a significantly large pullout from debt funds overall, including overnight liquid funds and so on. But also, probably the size of the industry was significantly smaller in 2008. So the redemptions was the magnitude of the redemption seemed more then. So those are the reasons. But I think it cannot be done away with. You cannot get rid of this risk at all. And I want to point out to investors that this kind of mass redemption risk is also valid for equity funds. If you look at the Nifty Next 50, the so-called impact cost, that is the cost of buying and selling large quantities of those stocks, they're significantly higher than the top few stocks of Nifty 50, and therefore, if people pull out in fear, then you will have severe problems for Nifty Next 50, mid cap, small cap kind of funds as well. So it's not as if this is a problem exclusive to bond funds. And like I said last time, we cannot run away from investing in low rated bonds. Like I will show you, both the government and the regulator is keen on deepening the bond market, but the regulator will have to rework the scheme categorization rules and the investment mandate, and try and, in my opinion, one way this can work. I mean, at least retail investors can be protected to some extent, is if you separate the retail players from the institutional players. That is, have separate options for them, separate plans for them, where the institutional players cannot invest in the retail part of the portfolio and vice versa. One way, at least, to ensure only retail only participation is to have a tax saving bond fund instead of, or in addition to, an ELSS fund, equity savings fund. One can have a tax saving bond fund, and that can have a AAA rating, AA rating, whatever, low rated, high rated, that kind of thing. And this will have a lock in, and that lock in, it could be closed ended, like Sahil suggested in Asana Days of Wealth. And if it can be completely closed ended, then it will be all the more easier for retail investors to sleep easy that at least such a run cannot happen. There can be credit events, that's a different matter. At least there will not be a widespread run. So I'm going to get rid of this now, because I'm just going to start cutting the slides. So the government is committed to deepening the bond market, and the late Arun Jaitley said on the 1st of February 2008 in his budget speech he actually claimed that corporate bonds rated triple B are investment grade. Uh, the reality on the street is very different, but that's what he says. And he says that the regulator would like to, he wants the regulator to call A as okay for mutual funds, any other big institutions to invest in A bonds as well. So that is the reason why I'm saying the government is committed to deepening the bond market. They want more and more participation in the lower end of the spectrum, and they want to increase participation in all credit ratings other than the sovereign rate. So now again, like I said in last part, without institutional funding, the low-rated bonds, the economy will suffer. The mid-cap, small-cap stocks depend crucially on the borrowing in these segments, and it's very, very important for us to understand because of this six-fund closure, a huge component of funding for all these smaller companies have suddenly gone dry. It's a huge loss for them, and that could impact the stock market as well. At least certain stocks it will impact. Now, SEBI is also has some part to play in increasing the credit risk of these funds, not the six funds, but in general. They first came up with a categorization circular, and then they amended it in December 2014. See, for example, in the corporate bond fund, the original wording was those funds will invest 80% in AA plus or above rated corporate bonds. They changed it to they will invest predominantly in AA plus and above rated corporate bonds. Now, you please tell me what does predominant means. I can say I will invest 55% in AA plus bonds and 40% in triple B bonds, and say I have predominantly invested in AA plus bonds. Now, this is like giving, opening a huge loophole for mutual funds to do whatever they want. And take a look at the banking and PSU fund, same thing. Earlier it was 80% in PSU and banking stocks, then it became predominantly in banking and PSU stocks. So the SEBI has also had a huge role to play in the dilution of scheme mandates, and they have to tighten up the rules and clearly compartmentalize debt funds to make sure that investors can choose wisely. So what are safer fixed income alternatives at this time? Well, it depends. Like I've already mentioned, gilt funds are not safe. They are in fact quite risky, and if you run to safety for gilt funds, you could lose a lot of money, especially if the interest rate cycle changes. Instead of interest rates going down, if the interest rates start moving up, there can be tremendous losses in gilt funds, long-term gilt funds. Overnight liquid funds, like I've mentioned recently, they suffer from reinvestment risk. That is, when the bonds, newer bonds are available at a lower interest rate, then the NAV will keep the rate at which the NAV moves up will keep falling down. So, what I mean is the rate at which the NAV moves up will slow down, and that slowdown would mean lower returns. You can see my video on the overnight funds. Now, arbitrage funds can have significant amount of bonds. Again, thanks to SEBI, they have credit risk as well. Cooperative banks, we know that they have a bad history. There's no need for us to put any kind of money in cooperative banks. Small finance banks, I believe they will have a problem, and they will have NPAs increasing because of the lockdown. So please stay away from small finance banks. They are a new kid on the block, and I think it's dangerous for investors to play with their money there. Now, even the big banks are suffering from NPAs. That 5 lakh deposit will not help you much. If they place restrictions, will not help you much. And even in closure, that may take time. There are legal hassles. It can take months and months and months to get that 5 lakh. It's not going to be easy. Now, post office have got sovereign guarantee, poor service, but then there is reinvestment risk. Now, people are now suddenly interested in bonds. I don't know why. Look, please don't buy bonds unless you have a income requirement. If you don't have an income requirement, the taxation, regular taxation on those coupon payments will essentially degrade your capital significantly over the long term. There's really no reason for young people to buy bonds, whether it is from RBI or whatever. If your parents want income or something like that, that's a different matter. But I honestly don't see why young people need to buy bonds. So How to select a debt mutual fund? I've been talking about this for a long time. I'll say it again. There are two kinds of basic risks in a debt mutual fund. One is the visible risk in the NAV moving up and down. That's called duration risk or interest rate risk. The other is the invisible risk, which is essentially the credit rating risk. You have to look inside the portfolio for understanding the credit risk. There are no clear wordings in the scheme documents. They say one thing and do one thing. They will say one thing in the scheme documents and then they will do something, then they'll say something else in the leaflet. So you don't know what is the right strategy. The scheme, the information document is just some bland, some legal document to basically save the mutual funds from legal trouble. They'll just have some vague wordings in it. In the leaflet, they say something, but that words are not backed up in the scheme document. So it's a very confusing space. So my suggestion is please look at the average portfolio maturity of the fund from the fact sheets, and then also look at the quality of the portfolio. The higher the average portfolio maturity, the more will be the fluctuations in the NAV. Please recognize that the yield to maturity is not a return measure; it is a risk measure. Higher the yield to maturity, higher is the credit risk in the bond fund. Now, for short term and long term, please use only liquid arbitrage funds or overnight funds. For income on short term, for investments, you can, if you can accept the NAV volatility, you can use gilt funds, you can use corporate bond funds or banking and PSU funds, but you got to be careful with the credit quality and you have to do some research. It's not easy. So again, please recognize this is the graph that I showed in the market outlook. This is the USD INR versus Nifty graph. The USD INR is in red. That circled region there, that's when the RBI had to step in and stop speculative trading of the dollar, of the speculative forex trading to weaken, and that was weakening the rupee. So they stepped in and stopped that, and when they stopped it, the interest rates subsequently started increasing, and that basically crashed all debt mutual funds. Every fund, even liquid funds, crashed during that time. And so you got to be careful. Like I said, higher the average maturity of the portfolio, higher will be the sensitivity to interest rate changes, sensitivity of the NAV to interest rate changes. If a liquid fund falls due to an interest rate up movement, it will recover within a few weeks. But if a long-term gilt falls, it may take months and months and even a year to recover. So please be careful about that. And I strongly urge you, if you're interested in debt funds, to go to my post called "Why do you need to worry about duration if your mutual fund invests in bonds?" And please, there are study those examples. There are nice examples of Macaulay duration, modified duration, and so on. I think I made a video on this. I'm not sure. I don't know. If I make a video, very few people will actually watch it. That's the truth of the matter. Everybody wants return, but nobody wants to do the work. Then I have a free ebook called Beginner's Guide to Investing in Debt Mutual Funds. Please download that and have a read. It gives you the basics. I have to add the possibility of mass redemption risk, which I did not appreciate earlier. But then, other than that, whatever is written there is reasonably valid. So finally, this is the sad state of debt mutual funds today. There is no clear demarcation of debt mutual funds. SEBI only divides mutual funds by duration risk, that is interest rate risk and not credit risk. There are no short-term debt mutual funds dealing exclusively in gilts. They were there, but they died after the SEBI regulations. There is no fixed maturity plan exclusively investing in gilts. I had talked about the possibility of an interval fund, that is, it is a closed-ended fund that opens a couple of days every quarter, every 6 months or so. That if that kind of an interval fund held only gilt bonds, then that's basically safer than a fixed deposits. But that such a thing is not available. I don't know why. But I also believe that soon when interest rates start increasing, then people will say liquid funds will always give 9% returns. Then all this episode will be forgotten and people will forget about credit risk and all the same mistakes will again be made. That's probably what's going to happen. But that's the state of the situation now. I think that's the last slide. Yeah, this is the market outlook which I talked about. So that was my talk to the TNIA. If you have any questions or comments, please leave them below. Thank you. Bye-bye.